presentations. Good morning. Good morning. Lenders, servicers, technologists, academics, entrepreneurs, advocates, regulators, all parts of the housing ecosystem, welcome. Thank you for coming and joining us, both in DC and on the live stream. We're so excited to host you at FHFA for our second TechSprint, Generative AI in Housing Finance. Before we begin, we'd like to remind everyone that today's session is being recorded. Please make sure your devices are on silent mode and enjoy today's event. I'm Tracy Steffen, FHFA's Chief AI Officer and Head of the Office of Financial Technology. It is my honor to get us started on a 4-day exploration of the potential generative AI may have for solving some of the biggest challenges in housing. But we're not just going to identify potential solutions. We're not just looking for use cases. Our teams, all of you, are also going to be proposing the control measures that can mitigate the potential risks of using this new technology. To achieve recognition, teams must not only have the most promising solutions, but also the most thoughtful and appropriate control measures. Why? Because we believe mitigating risk is as important as the use cases. It's actually not just important, it is the key. Regulation can accelerate the advancement of technology if we provide the right guardrails to help people avoid dead ends, errors, and pitfalls. If we, in partnership with other regulators, develop appropriate policies, housing market participants will be able to have the confidence they need to develop and use new tools effectively in a safe and sound manner. In other words, regulation can help us help the entire ecosystem innovate responsibly. Before we start, I would like to thank everyone in advance for all the work that it takes to put our TechSprint together. We have team members, judges, speakers, subject matter experts, staff, volunteers, security, facilities, and catering, to name just a few. A lot of people have put in a lot of hours to make this happen, and a great big thank you to all of them, and thank you to everyone who made it to DC despite challenges. So let's have a look at today's agenda. First, we're going to start with opening remarks from FHFA Director Sandra Thompson. Afterwards, I'll get to sit down for a chat with Lisa Rice, President and CEO of the National Fair Housing Alliance. Then Lori Goodman from Urban Institute will talk about the potential AI applications and policies for housing and housing finance. Unfortunately, Anne-Marie Pippin, FHFA's Deputy Director of Division of Conservatorship Oversight and Readiness, who was originally scheduled to give the closing speech today, has been caught up in technology and in the travel delays that hit last week. She sends her best and apologies for not being here and asked me to give her final remarks in her place. So I'll close us out with those remarks that Anne-Marie would have given to frame the events of the next 3 days and inspire our teams and send them on their way. But now, it is my pleasure to introduce the Honorable Sandra L. Thompson. Director Thompson has over 40 years of private and public sector finance experience with expertise in supervision, consumer protection, risk management, and consumer outreach. Prior to leading the agency, Thompson served as Deputy Director of the Division of Housing Mission and Goals, overseeing FHFA's housing and regulatory policy, capital policy, fair lending, and mission-critical activities for the regulated government-sponsored entities, which are, for those of you who might not know, Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. Before joining FHFA, Thompson worked at the Federal Deposit Insurance Corporation, FDIC, for more than 23 years in a variety of leadership positions, including as Director of the Division of Risk Management and Supervision. She knows a little bit about risk. She is a graduate of Howard University in Washington, D.C. Director Thompson.
Every time I hear that 40 years, it just drives me crazy. And we didn't even go back as far as we could have and talk about Goldman Sachs and other places. But good morning to everyone. And thank you all for joining FHFA's second annual TechSprint on generative AI in housing finance. I'm so glad we're doing this event again this year. We learned so much from last year's event. Last year, we focused on how data digitization could drive transparency and increase access, fairness, affordability, and sustainability in mortgage lending. And we saw the power in coming together to inform tangible solutions to ongoing challenges for borrowers. Our job at FHFA is to ensure that Fannie Mae, Freddie Mac, and the Federal Home Loan Banks fulfill their mission by operating in a safe and sound manner so they can continue to serve as a reliable source of liquidity and funding for housing finance and community investment throughout the economic cycle. Essential to fulfilling this mission is understanding the opportunities and challenges in housing and housing finance, as well as the evolving needs of lenders, investors, homeowners, and renters. For many years now, we've been exploring how technology can help us address those challenges, and we want to make sure that new ideas, new products, and new processes result in positive outcomes for both industry leaders and consumers. And we do want to take into consideration both the risks and the benefits. In other words, our goal is to promote responsible innovation in housing finance. Despite years of digitization and the ever-accelerating evolution of technology, the housing finance industry depends largely on paper-driven processes, and it's been that way for well over 30 years. By harnessing the power of innovation in our industry, we can also make progress towards solving long-standing challenges our industry faces, such as closing the homeownership gap and addressing the lack of credit access and credit availability in underserved communities. That's why FHFA has been leading in this area, particularly within the regulatory community. For example, FHFA appointed Tracy Stephan as our Chief AI Officer earlier this year, and we also established an AI steering committee to advise FHFA leadership on AI matters, not just for our regulated entities, but for our own agency. With generative AI already changing the world around us, having a chief AI office is critical to helping FHFA understand how emerging technologies are currently being used, how they'll be used in the future, and the risks and benefits to the industry and consumers. A critical piece to understanding these risks and benefits is working collaboratively with stakeholders as thought partners to identify best practices, solutions, and ideas. This is exactly why we host a TechSprint, and I'd like to take a moment to highlight how some of the ideas from last year's event have already made an impact. Our 2023 TechSprint brought together housing finance and technology leaders to explore innovative digital solutions to further promote efficiency and cost savings in mortgage lending. The participating teams presented truly compelling ideas. For example, one idea advanced the concept of a centralized portal to improve access to down payment assistance programs for potential home buyers. And there are now several tools like Freddie Mac's DPA One, which is the down payment assistance one, that help lenders more easily identify programs for home buyers that they might qualify for. There's lots of down payment assistance programs across the country in financial institutions, and it's hard when you're a borrower to figure out which programs exist and which ones are a good fit for you. So by bringing all these down payment programs together in one place, it allows the lender to help the borrower figure out the criteria and parameters for the programs that they are qualified for. Another idea that emerged from last year's TechSprint focused on using generative AI to educate first-time home buyers about the mortgage process. Today's TechSprint continues to build on themes of benefiting both industry and consumers, and we're already witnessing the positive impact that technological innovation can have when it's done in a safe, ethical, and fair manner. For example, The enterprises are now using advanced technology to identify positive rental payments and gig economy income sources within asset reports in the enterprise's automated underwriting systems. The positive rental payment history programs report on-time rental payments to the credit bureaus from renters who live in properties that are financed by Fannie and Freddie, and this has been significant. In addition, FHA has also adopted the positive rental payment program. But both enterprises have already helped nearly 900,000 renters establish or improve their credit scores through this positive rental payment history. And this will also help them if they choose to pursue homeownership or not, because many renters have either thin credit files or no credit files. So building their credit in a positive way is very helpful to making sure that they have credit, whether it's homeownership or a car or whatever they might need credit for, but it helps establish their credit worthiness. Additionally, the enterprise's automated underwriting systems now leverage the power of AI to identify income sources from bank statements for gig economy workers to support cash flow assessments and increase access to credit for borrowers. Many people don't get paid every 2 weeks, and many people have other forms of income like TikTok or Uber, or pick something that wasn't around 30 years ago. And so it's important for us to acknowledge and implement processes that take into consideration how we're living today. And we're able to use that with the help of generative AI and the technology that has been beneficial to Fannie and Freddie in terms of helping them understand some of the income dynamics. So we're really excited about it, and we're hoping that you all can see that we are trying to remain thoughtful about the role technology can play within the housing finance ecosystem. It's our goal that this tech sprint will help us better understand how we can unleash generative AI's full potential in a responsible way and capitalize on this historic opportunity. I believe that depends on our ability to answer two critical questions. First, can generative AI help us improve the consumer experience when potential home buyers are researching or obtaining a mortgage? And second, could AI help improve industry operations by enhancing efficiencies or strengthening risk management? I'm optimistic about this year's tech sprint, and I know that it'll help us explore answers to some of these questions. And more so, I really look forward to seeing how far we advance this conversation throughout the week. I'm absolutely going to be at the report outs on Thursday. I'm excited about it. I specifically asked to make sure that we not only focused on single family, but we also focused on multifamily, because the enterprises and the home loan banks engage in mortgage lending across the spectrum. So I'm really excited about it. I really want to thank you all for joining us today and being a part of this tech sprint. And with that, I'll turn it back over to you, Tracy. Thank you so much.
Thank you, Director Thompson, for reminding us exactly why we are here, of the urgent, longstanding, and historical challenges facing housing, and of the unprecedented potential of technology to help solve them. Let's take a few moments and imagine the possibilities.
A home is more than just a house. It's the center of your life and the foundation for your future. A home is often the largest asset a family owns and serves as a primary way to build wealth that can be passed on to children and grandchildren. And regardless of whether you rent or own, a home provides you with stability and a sense of belonging and community that goes far beyond its monetary value. Yet many people encounter challenges securing a stable home. Renters grapple with housing affordability as rapidly increasing rent costs outpace wage growth. leaving half of all renters finding it difficult to afford their rent. And people trying to buy a home often struggle with a complicated financing process. One where the average cost to originate a mortgage has increased by a third in the past 3 years, and home prices have surged over 50% in the past 5. And the racial homeownership gap is wider today than it was 50 years ago. With these challenges, many Americans are at risk of losing access to homeownership. And people who prefer the community and flexibility of renting or may not be ready to buy a home are finding it harder to find a place to live, no matter what their incomes are. But what if we could harness technology to solve the biggest challenges in housing, like we do in other industries? To create a more equitable and sustainable housing finance system, where renters are able to find more affordable housing, where the path to homeownership is more accessible for everyone, and where both renters and homeowners are provided with the information and resources they need to stay in their homes through financial hardship. FHFA believes this future is possible. That's why we've brought together experts from across the industry for a tech sprint to explore ways to improve housing with generative AI. While generative AI holds immense promise, it also comes with risks we cannot ignore. And realizing its potential depends on using the technology responsibly, maximizing benefits, minimizing risks, and ensuring safety and soundness. FHFA believes that together, we can foster this kind of responsible innovation to promote a transparent, fair, equitable, and inclusive housing finance system. One that meets the changing needs of lenders, investors, homeowners, and renters. FHFA calls upon all participants to rise to these historic challenges through collaboration and innovation. Because we're stronger together. And what we create today will shape the communities of tomorrow.
What we create today will shape the communities of tomorrow. That could be the vision or mission statement for the time we are spending together this week at the Tech Sprint. I want to thank you again, Director Thompson, for reminding us of that. Now, it is my pleasure to be joined on the stage by Lisa Rice, President and CEO of the National Fair Housing Alliance, to talk about some of those challenges, what's being done or might be done to solve them, and what we need to do as an industry to ensure the responsible use of technology to enhance equity and uphold privacy. The National Fair Housing Alliance is the nation's only national civil rights agency solely dedicated to eliminating all forms of housing discrimination and ensuring equitable housing opportunities for all people and communities. Lisa has led her team in using civil rights principles to bring fairness and equity into technologies used in the housing and lending sectors. She served on the Bipartisan Policy Center's Civil Society Advisory Council on Artificial Intelligence and FinReg Lab's Board of Directors. Lisa, thank you for joining us on opening day of our Generative AI in Housing Finance TechSprint. Lisa. Lisa, thanks again for joining us. Let's jump right in.
Of course, my pleasure. Thank you for having me.
You've committed your life and work to eliminating discrimination in housing, something that the National Fair Housing Alliance counts itself as the only national organization dedicated to doing. Can you share with us what led you to this area of focus, and why are you so passionate about increasing fairness and eliminating discrimination in housing outcomes?
Sure, and thank you for that question. I grew up in the Midwest in Ohio, and when I was growing up, discrimination was a way of life in my community. Discrimination was something that we knew was wrong and had a sense that there should be some laws that made the experiences that my family was going through and that so many of our friends were going through, that they should be illegal and that they should not be allowed in our nation. When my parents went to purchase their home in 1963, my mother wanted to purchase a home in a suburban community on the outskirts of Toledo, Ohio. That's where my parents met. Both of my parents were raised in the Jim Crow South. Mm-hmm. So my mother and my father only had a 6th grade education because the schools in Arkansas and Alabama, in the communities where they lived, the schools for black children only went up to the 6th grade. So my parents, their educational attainment was restricted because of the Jim Crow laws that existed in those 2 states. So they both migrated actually north so that they could vote, because in Arkansas and Alabama, they weren't able to vote. And so when they wanted to purchase a home, my mom found this house, and the real estate agent said to her, "Mrs. Rice, I'm sorry, I can't even show you the house. Because if I do, I will lose my license. It's not that I don't want to, but I will lose my license." And she was not lying to my mother. She was telling the truth. Because at that time, as you all well know, the National Association of Realtors had a code of ethics that required any real estate agent who wanted to use the multiple listing service and be a member of NAR, they had to engage in residential segregation. So my parents couldn't buy the home that they wanted and ended up living in the community where we lived, which was a red line community, a systemically disinvested community. So discrimination hit me hard, it hit my family hard, and I thought, this isn't right. And when I was 15 years old, I got an internship at the Toledo Fair Housing Center, and I got bit by the civil rights bug, and I'm still here today. Art major, undergrad and grad, went to school in France. I'm supposed to be really in some alternate universe, living on the shores of Ghana painting, but here I am.
Well, we're glad you're here with us today and doing such important work. So if you think about today, what do you see as the biggest challenges right now complicating access to fair housing for both prospective and current home owners?
There are many challenges, unfortunately, and I think the biggest challenge that people are seeing every day are the just exorbitant costs of housing, both rental housing and housing for purchase in the United States. Housing prices have elevated tremendously, in part, unfortunately, sometimes because of AI. What we're seeing with dynamic pricing systems is that they're causing an elevation in rental housing rates, even when properties have high vacancy rates, which does not make sense. But it reduces competition, right? Those dynamic pricing systems. And so housing costs are just a major barrier. The lack of affordable housing units is a major barrier. And then we also have other kinds of systemic barriers like appraisal bias. We still have redlining, unfortunately, and other forms of discrimination and systemic barriers that are keeping people, locking people out of the opportunity to secure stable and safe and affordable housing.
So are you seeing, anything that has been successful in addressing these challenges in either single family or in the rental space?
Yes, we are, and that's part of the work that we do at the National Fair Housing Alliance. So we try to remove barriers that are unfair for people and replace them with systems and constructs, structures that are fair and equitable for everyone. But because we do have lots of barriers that are structural, it's hard to break through those barriers. I'll give you an example. So for hundreds of years in the United States, we have passed race-based, race-conscious laws that were designed to afford some people in our society access to homeownership and purposefully, deliberately foreclose the ability of others to access opportunity. And so those laws and policies created inequitable frameworks and systems like residential segregation. We are still very residentially segregated. I explained to you how my family was forced into a segregated community. That neighborhood is still segregated today, right? We have, in fact, we're more residentially segregated today than we were 100 years ago.
Wow.
Because once you build and develop these systems, it's hard to deconstruct them, right? We have a dual credit market in the United States in which banks are hyper-concentrated in predominantly white communities, and non-traditional lenders that do not report positive transactional behavior to the credit repositories, they're hyper-concentrated in communities of color. So that dual credit market is still in existence today, right? So we have all of these different there are a plethora of these systemic barriers. And so we're working to both dismantle them, but also build what I call on-ramps that help people circumvent these systemic barriers so that they can on-ramp into mainstream financial, affordable, safer credit opportunities. So one of those things is special purpose credit programs. We've been doing a lot of work, probably the leading organization in the nation, to make special purpose credit programs possible. Special purpose credit programs are available under the Equal Credit Opportunity Act. They allow lenders to design credit programs that meet the special needs of underserved consumers and people. And you just heard Director Thompson talk about the increased ability to use rental housing payment information to qualify people. Well, we really don't have an infrastructure to allow people to use rental housing payment information. And so one of the things that we do is help lenders design programs so that folks can more readily use rental housing payment information to access affordable and safe credit opportunities.
Yes, as Director Thompson mentioned, there are programs. We are making small, as an industry, making small progress. And we're here today and this week to work and to see what generative AI, right? And I know you've spoken a lot about artificial intelligence in the past, and I've had the pleasure of hearing you speak on it. And I would love for you to tell our audience here in the room and watching on the live stream, when AI and Gen AI, this ramp up in the past 2 years, what were your initial thoughts? And then, have those initial thoughts evolved over time?
Oh, that's an interesting question. My initial thoughts were ones of fear and trepidation, to be honest with you. These systems are highly powerful, and I was afraid that entities would release systems that were unconstrained, which has happened, as we well know. Unconstrained models are wildly dangerous, and we have no laws. We do not have a sort of omnibus or comprehensive statute to govern the area of AI in the United States, which is frightening in and of itself. So it's sort of like the wild, wild west, and we have to rely on entities that are developing and using these systems to use responsible AI principles when they're doing it. Not all entities are doing that,
Right.
as you know. So yeah, I was very afraid. Maybe this is just a part of my nature, I don't know, but when I see a problem, I want to try and fix it rather than bury my head in the sand. And I think that's what civil rights experts do. We don't bury our head in the sand. So we got to work to try and develop principles that responsible entities could follow if they wanted to do the right thing. And we've also been working to try and put in place legislation to address these issues, as well as try and help people understand how existing laws can be used to protect consumers and to ensure these products are safe.
Did you want to talk a little bit about the framework and kind of the partnerships that you're developing to advance the responsible use of AI?
Sure. So we developed a framework a couple of years ago it's the state-of-the-art framework for auditing algorithmic-based systems. It's called Purpose, Process, and Monitoring. I've been told by a number of marketing professionals that we need to change the name. So working on that. You'll see 2.0 sometime soon. But it is a comprehensive framework that helps entities audit their systems responsibly from soup to nuts. So from the pre-development stage, the development stage, and post-deployment stage, you can use this framework to make sure that you're accurately and responsibly monitoring your systems so that they are not perpetuating harm in our society. We also are doing a number of things. I serve on the advisory council for the Leadership Conference on Civil and Human Rights, Center of Technology, and so we're working on policy frameworks there. We also are working with federal regulators and federal enforcement agencies to help train them and also to help them understand how they can use existing laws and policies to help sort of police and provide oversight in this area. And we held our first Responsible AI Symposium earlier this year, and we had the privilege of talking to the leaders of the four major federal regulatory agencies. And if anybody missed that, you can look on our website and access that panel discussion. And one of the things that the regulators said was that they do acknowledge that we have existing frameworks, existing policies, and they do expect anyone who is using any form of technology, AI or otherwise, to develop and implement those technologies within the constraints of existing guidelines. And they also said that you're not going to be able to say, well, the tech is so complex, I couldn't understand it. Nobody can understand it. You're not going to be able to use that as sort of a get out of jail free card, like a pass, or a safe harbor to avoid responsibility in this area.
So policies, frameworks, and I imagine a world where we do get our act together as an industry so that we can responsibly innovate. So I would just love to, know what you see as opportunities for generative AI specifically to help reduce bias or discrimination or bring improvement, as we've been talking about, to the housing industry. What are your wish lists?
Well, that's an interesting question. So I did say before that when generative AI models like ChatGPT, et cetera, were introduced into our society, it did cause us some fear and a bit of angst. But we soon began to see that we could use these tools to actually help people, and we could use these tools to help us advance civil rights and fair housing and fair lending principles. So we're using the tools in what I believe is a very positive way to advance the ball. We're even using the tools in our enforcement work. So we're using the tools to help us conduct investigations, to identify discriminatory practices, and to measure the extent of discrimination. For example, last year we held a hackathon in which we looked at automated valuation models. The hackathon was designed around identifying and measuring bias within AVMs and developing ways to mitigate the bias in those systems. So we did find that AVM models can perpetuate bias and discrimination, largely because the models are built on a data set that is infused, unfortunately, with a long history of biased transactions. And so we're also looking at using AI to mitigate bias within systems. And I can talk about that more, but we just released research around a new innovative approach for reducing bias in legacy systems and for building systems in a fairer way going forward. So we're using AI in many, many different ways to help advance the ball and make the landscape fairer for consumers.
That's fantastic. Before I open it up for questions, I just want you guys to start thinking about your questions for Lisa, because she has been so generous with her time, and we do have mic runners. I'll give you guys a few moments to think about your questions. But I would like to know, for those in the room, we have quite a few lenders, single-family and multifamily lender representatives here. And so what advice would you have for them? What should they be considering in terms of their use for Gen AI and managing risks?
Well, one of the things that lenders should be considering is what are the policies, the existing policies that they have to ensure that they're building technologies or using technologies developed by third parties in a fair way, particularly if they are using technologies that are developed by a third party. They have to be able to examine those systems. We brought a lawsuit against a major financial institution a number of years ago, in fact, in the 1990s, that financial services provider, it was an insurance company, they were using a third-party, off-the-shelf insurance scoring system, and they had not properly vetted it. In fact, at the time, they didn't even have staff within the organization that could understand that tool. So they basically were listening to the sales pitch, and the sales pitch said, oh, no, it's fair. Sure. It's based on data, right? It's a computer that's generating the decision. Computers don't see race. Computers don't see gender. And the insurance company bought it, and they started using this insurance scoring system that was perpetuating discrimination and bias against stakeholders. In that case, we had to prove that the discrimination was being perpetuated, but we also, because of the way that civil rights laws are, the civil rights jurisprudence in the U.S. is sort of constructed, we had to also prove that there was a less discriminatory alternative to that model, which we did. We could build a fairer model. And so lenders have to make sure, like, they're not gonna get a pass, right? So they've got to make sure they understand that technology, and they have to make sure that they can explain the technology, the decisions emanating from the technology. They also have to make sure that they have civil rights experts within the organization that are looking at these systems and analyzing them through a civil rights, a fairness, and equity lens.
Great advice, great advice. I'm going to turn it over to the audience. And I know you must have some great questions out there. We have 2 mic runners. Happy to, there we go, right in the middle, we'll start. Just wait for the mic, because we do want the folks on the live stream, hey there, to be able to hear us.
Hi, Hi, thank you. I'm Siggy Johnson from Better Markets. Everything you've been saying resonates so much with us because once you remove the people and you kind of stick to the data, that's where kind of you don't see who the person is, you see who the borrower is. But it's very interesting when you say you can have models that actually kind of create implicit bias because of how the data is used. So my biggest question here is, when you look at modeling, you have traditional models that can be explained, like here are the factors that go in, here's the relevance, et cetera, et cetera. But then now you're having more of neural network models, which are totally different because in a neural network, you train the model, but you can't explain why it comes to a certain conclusion or not, as with the traditional models. Now, they do have some benefits because they're able to catch a bunch of correlations within the data that traditional modeling would not catch. But at the same time, the only way to debate them is you run them again in various scenarios and you try to make some conjectures about what's going on. So the question here is, do you think we can ever get to a position where we are trusting neural networks with actual scoring and decisioning and lending decisions? Or do you think that's an area that, like, we always need the explainability, so we will probably not end up there?
Yeah, that's a great question. I do think that we will ultimately get there, and here's the punchline. It may take AI to enable us to get there, right? It may be the case that very sophisticated AI models are what help us understand and explain how those neural network systems work. Having said that, as entities are building these models, you have to have civil rights experts on your teams who can understand, who analyze and can understand the underlying data used to build that neural network so that you're very clear about whether or not you're having biased inputs going into the system as you're developing it. And I can tell you this now, if you are using any data from the housing or financial services markets in the United States of America, you're going to be using biased data. So now what do? You have to constrain that model, that neural network, for fairness. I'll talk a little bit about research that we've just released using an innovative approach called distribution matching that allows you to optimally constrain systems for both fairness and profitability, which is what, let's just be honest, that's what most businesses are looking for. So they want to make sure that the systems they are using can be optimized based on profit, but if you optimize based on profit alone, you're going to be building a discriminatory model. We know that. You have to simultaneously optimize your system for fairness. And because the data that we're using to build these systems is already embedded with bias, you have to force and compel, you have to design it from the outset in a way that is forcing and compelling the model toward fairer outcomes. Will that system be completely non-discriminatory? No, it will not. We know that. But if you're constraining it for fairness, that is the way that you're going to ensure that you're using a less discriminatory alternative. I was talking to one of the executive leaders at Freddie Mac about this problem that we have. It's an inherent problem. We can't get away from it. And I asked him, I said, just based on what you know about the industry, when do you think we'll get to the place where we'll be building models based on data that is not embedded with bias? And he said at least 100 years. So that lets you know that if you're not constraining your system for fairness, you're probably in trouble. Which is why we're doing the research that we're doing at the National Fair Housing Alliance at NAFA. It's why we're doing that research. It's why we're trying to bring more tools on board to help entities constrain their models, especially legacy models and third-party models for fairness. It is a lot of work, but it's really necessary that we do that, because if we don't do it, we'll never get to where we want to be.
Thank you for that question. I think we have time for at least one more question. I saw here, and then here.
Thank you. Hi, Melissa Cornwell with North Point Bank, fellow Ohioan, go Bucks. My career has been in single-family housing for the entirety of it. However, I've been placed on a team meant to discuss multifamily lending. We've got a great team with a lot of subject matter experts, but I would love to hear from your perspective, where do you see opportunity for fair lending within a multifamily transaction, especially when the borrower on the other end is typically an investor for profit?
Yeah, that's a great question. And so one of the things that we strongly advocate is that when you are lending in a multifamily environment, that you're including protocols or requirements within those loan documents that will push us toward fairer outcomes. So for example, you're going to include things like making sure that the collateral being used to underwrite this multifamily loan, that collateral is built within code and that it is compliant with different codes. But you also want to include things like making sure that anyone that the multifamily housing developer is not going to be discriminating against people who use housing choice vouchers, and that the underlying collateral is going to be built in accordance with our nation's civil rights laws, the Fair Housing Act, the Americans with Disabilities Act, so that there are no accessibility violations, and ultimately that developer will not be subject to liability under a civil rights laws for building a complex that is not compliant. So things like that you can use. You can also, if you want, follow Fannie Mae and Freddie Mac's lead and require or encourage or incentivize that multifamily housing developer to report rental payments to the credit repositories. So there are lots of positive things that you can do to push us toward fairer outcomes.
Thank you so much for the question. We have a speed round. If we have time for one last quick question and response. I can hear you. I'll repeat it.
Thank you so much for sharing your insights. My name is Sudhir, and I have been in the IT industry, tech industry for now 20 years, working a lot on the AI and ML models. One thing that I would like to ask today is about the people part of this entire conversation. We have the AI, we have the models, we have the new tech hitting the markets. People need to be upskilled. People need to be reskilled. We need to have people ready to govern the models. We need to have people ready to monitor what is going on. We don't need another incident like what happened last week, especially with AI hitting the market so vigorously and so fast. Any thoughts on this, ma'am?
Yeah, so our purpose, process, and monitoring framework, remember that framework I told you the marketers told us we need to rename? It includes a people component in it. So I encourage you to read that framework. People have to be, as you said, as you suggested, we need to include people who are highly trained and highly skilled. Include those people in the development and the deployment of the model. That's really important. because when you have people who are trained on civil rights, fair housing, and fair lending laws, they can help ensure that those models are going to be built, or those systems are going to be designed in a fairer way. People are surprised when I talk about our lawsuit against Facebook. They cannot believe that Facebook did some of the things that they did. So for example, if you were advertising if you were trying to place an ad for a lending, a housing, or employment opportunity on Facebook's old system, you could literally say, I don't want Black people to see this ad. I don't want Latinos to see this ad. I don't want Asian Americans to see this ad. Now that sounds crazy, doesn't it? But they built and designed the system because the people who were in that designing room were not trained on civil rights. They didn't understand our US-based civil and human rights laws. So those kinds of absurdities can exist if you don't ensure that people are highly skilled and trained on these critical issues as a part of the process of building the system. The last thing that I'll say, because you mentioned it, and I don't know if you meant the outages that happened this year where, banks were shut down and 911 systems were shut down and airline systems were shut down. But I think it is an example of why we really have to ensure that we're always including a human alternative. And if you look at the AI Bill of Rights, that human alternative is that fifth component, because sometimes the technology won't work. And even if the technology is working, it may not be the best solution for a particular group of people. And so you need to make sure there is always a human live or manual alternative so that people aren't being unfairly discriminated against.
Absolutely. Thanks for the question. I want to thank you again, Lisa, for sharing your time and insights with us. I do recommend you all go to the National Fair Housing Alliance website and check out the resources. They are quite comprehensive, and there's always more. And give us a lot of things to think about for the TechSprint teams to think about as they ideate, and for us all to think about. So please join me in thanking Lisa.
Thank you so much for having me. Thank you.
Thanks again. I would like now to introduce our next speaker, Lori Goodman, a fellow at the Urban Institute, where she founded the Housing Finance Policy Center. Before joining Urban, she spent 30 years as an analyst and research department manager at several firms on Wall Street. Goodman serves on the board of directors of MFA Financial and Arch Capital Group and is consultant to the Amherst Group. She has published more than 200 journal articles, co-authored and co-edited 5 books, has a BA in mathematics from the University of Pennsylvania, and an AM and PhD in economics from Stanford University. Dr. Goodman.
Well, thank you so much for having me here today. This is very exciting. And I'm going to actually pick up many of the themes that both Director Thompson and Lisa Rice talked about. The outline of my talk is as follows. I'm very excited about the applications for generative AI and housing finance. It has implications both for home ownership and for rentals, and we're going to talk briefly about both of them. I'm then going to make the point that efficiency isn't always beneficial for consumers. I'm going to pick up many of Lisa's themes in AI bias, and then talk briefly about what has been done so far in the regulatory arena, and then conclude with some policy recommendations. First, to set the stage, AI has the potential to both enhance efficiency and equity. In efficiency, AI brings the promise of efficiency gains in processing time, underwriting accuracy, and could improve origination volumes. It can improve efficiency and accuracy while reducing labor costs, and by the way, improving the consumer experience. On the equity side, by incorporating alternative data, a point Director Thompson made, converting unstructured data and using newer techniques for finding less discriminatory alternatives, AI could greatly expand access to mortgage credit. So let's talk about AI throughout the single-family mortgage life cycle. In terms of pre-mortgage preparation, you can think in terms of chat boxes to answer consumer questions. You can think about FHA putting up a series of questions and then giving people a personalized to-do and information list, including things like, would I be eligible for down payment assistance when you're first thinking about applying for the mortgage rather than when you're actually in the process. I am most excited about AI in terms of assessing borrower creditworthiness. Generative AI could greatly expand the use of bank statements. As Director Thompson mentioned, Freddie and Fannie have taken some really major steps in this direction by using bank statements to detect on-time rental payments. Essentially, the way this works is someone submits a mortgage application. If they're not an accept, but they're reasonably close, the program says, would the borrower qualify if they had 12 months of on-time rental payments? If the answer is yes, Fannie and Freddie go back to the originator and say your borrower would qualify with 12 months of rental payments. The originator contacts the consumer agrees to provide the bank statement information. They then get a link from the lender's asset verification provider, and they provide the asset verification provider with the information, which is then passed on to Fannie and Freddie. This is actually a big improvement in the sense that you're using on-time rental payments. However, it would be even better if it were incorporated into the process from the very beginning. So, for example, one can envision better propensity to pay measures based on both credit scores and bank statements. Form Free and Guild had a pilot along this line, but it's very, very easy to think that bank statements could help augment one's credit score to produce better information on your ability and willingness to pay. As Director Thompson mentioned, income could be more accurately captured from bank statements than from tax returns. This is particularly true for self-employed borrowers. It could be used to capture the consistency of income for those with a second and third job. It could be used for multi-generational households where some of the income, where the rental payments have been made by borrowers who are not on the mortgage. So you could actually think of great advancements in terms of AI and assessing borrower creditworthiness. In terms of home appraisals, automated valuation models obviously rely on AVMs. As these automated valuation models continue to improve, we can think more about not completely eliminating the human appraiser, but sort of giving them the AVM data to begin with and saying, is the data on the home itself correct? Is the square footage right, et cetera? And then is the condition approximately what the AVM model has assumed, and basically sort of use the AVM model as a base rather than use the human as a base. You can think of the use of AVM models in terms of fraud detection, sort of stolen identities and things like that. There's been a lot of talk about using AVMs in servicing. You can think, sort of talking to a chat box when you're in financial difficulty isn't anyone's idea of fun. However, what you can think of is AVMs, what you can think of is AI augmenting the experience when you're on the phone with a human being. And we're not very far along with this at all, but if I'm on the phone with a human being, the AVM could be running, the AI could be running in the background summarizing the information about me. It could then sort of prompt the human being to say, have you asked about this? Have you asked about that? So it does have potential, but then the question is, what training data would you use? So I think sort of servicing, while it holds tremendous potential ultimately down the line, it's hard to see AI being used extensively in the near term, although it could be used as a helper to human beings. Now let's think about AI in terms of rental opportunities. You can think about chat boxes to set up appointments to show apartments, make sure the lockbox has the correct code. You can think of lease creation, and then you can think of asking AI to just, hey, can you summarize that lease into one page to improve the consumer experience? Tenant screening is something where AI could actually be very useful for. Landlords often screen based on eviction history, criminal records, credit scores, and income, but we actually don't know which of these factors is actually predictive of future pay history. So, for example, might have had an eviction filing 10 years ago. Is that at all predictive, given that I've improved given that I've been a very good tenant ever since? So here's one suggestion, that we need reporting on tenant performance for GSE borrowers, and I would really love to see this because, as we talk about use of data, the lack of data really hinders AI in the multifamily space. So this would allow for the provision of better information on best practices, ensure fair housing, and build more predictive systems. It should include information on rent, security deposits, screening done and the results, unit size and location, as well as monthly rental payments. It should include landlord's actions, such as whether the tenant has received a 30-day notice on an upcoming eviction filing, whether the landlord has filed for an eviction, the primary reason for the eviction, and was the eviction completed? Because for many landlords, eviction filings are basically a rent collection technique, and very few of those evictions are actually completed. This would allow us to basically do predictive models for tenant performance. It would allow us to identify outlier landlords who evict too much given census tract and tenant information. So it would be very, very useful. Back to AI and other rental opportunities, making maintenance more efficient. So when you put in a maintenance call or a maintenance ticket, getting enough information so that the person providing the maintenance only has to make one trip out there, where there's enough information to predict the issue. So so what exactly is the problem with your air conditioner? Is it making a noise? Is it leaking? What exactly is the problem? Where do you think the problem could be coming from? So making sure the parts are available. There's also a lot of talk about using AI in terms of preventative maintenance. That is, looking at the average life expectancy of the equipment, having monitors in the home where it gives some idea of of equipment that's nearing the end of its life, and then looking at, for example, weather and saying, oh, that air conditioner, it's on its last leg and it's expected to be a really hot summer. Maybe we want to replace it now rather than replace it when it breaks in the middle of July. It could be used for fraud detection in mortgage applications. In multifamily, you have situations where properties where there's fraud and properties sell for ridiculous prices, given other comparisons in the area. It could allow you to look at the sales price history very easily and compare it to the area and help detect fraud in mortgage applications. Again, it could be used for on servicing, both in terms of rental payments and in terms of mortgage servicing, but I'm less optimistic in terms of servicing in the near term than many other areas. Now, I'd like to turn to the point that efficiency isn't always great for consumers. One party's efficiency can be another party's misery, the case of rate setting. So in terms of setting rents initially, those with better information tend to be more responsive to the market in both directions. On average, rent increases tend to be slightly larger, but the really big difference is the responsiveness. You've got better information, so you can better gauge the market. With AI, this better information will be more widely shared and used by a growing number of landlords. So let's just look at the case of large single-family operators, who tend to have better information because this is what they do. They scrape websites, they get information from all sorts of sources. So this is DBRS data on securitized SFR rent changes, which is the blue line. Rent range is 3-bedroom and 4-bedroom estimates, which are basically the market as a whole. So you can see that blue line is much more responsive. So when rents are going up a lot, the institutional landlords tend to be quicker to raise. When rents are softening, they tend to be quicker to soften their rents as compared to the market as a whole. On average, the differences are slightly larger, on the order of about 0.5% of the year, but the real difference, about 5.1% for the institutional landlords, about 4.4% for the rent range landlords, but the real difference is in terms of the responsiveness. Now let's think of let's take these examples a little bit further. We know that in some cases, renewal increases can be larger than vacancy increases, particularly in soft markets. In a hard market where rents are going up a lot, you basically usually give a break to the guy who you want to stay, who's been paying their rent. So if rents are going up 12% for the market as a whole, maybe you give your existing tenant an 8% increase and you do the 12% increase on the new guy that's moving in. However, in a softer market, landlords tend to go the other way. They say, well, gee, the market increase is 3%, but I can do 5% for existing tenants because they won't move. And you can see that very clearly on this next slide. You can see that the renewal rent changes tend to be much, much more static than the vacant to occupied rent changes. That is, over this entire period, the renewal rent changes were averaged about 5%. The vacant to occupied rent changes averaged about 5.6%, and this is this happens to be for institutional landlords. However, what if your landlord could combine this with information about you to further optimize? So they observed that Lori Goodman has had the same credit card for the past 10 years. She's passed up all sorts of lucrative offers because she's just too lazy to fill out the damn application. So they say, okay, well, and this is information that's very easily obtained from Lori's credit history. So they say, well, gee, Lori, rents are going up on average 3%. We're offering most renewals 5%, but we can offer Lori 7% because she can't even fill out the damn the damn credit card application, so she's apt not to actually want to move. So just bear in mind that there is some opportunities. Efficiency and better information isn't always a good thing. The question is, can AI help with some of the bigger issues, in particular housing supply? And I think there's potential down the road. We're beginning to just see the early signs of it. So AI could allow a developer to maximize the square footage or maximize any objective function on a property consistent with local zoning regulations, which could help increase density. So you're actually seeing this in California. There are programs available where they ingest the zoning rules for a particular location. They've ingested the building codes, and then they come up with hey, here's the maximum square footage accessory dwelling unit that you can afford to put on this property that would be consistent with both the zoning rules and the building codes. So I think we're beginning to just see the very early emergence of that. Can AI help affordable housing deals pencil out? So affordable housing deals are often quite complex with layers and layers of financing. AI could potentially help optimize the capital structure, but again, you'd need very, very good information on who the investors are and what training set to use for that. To pick up Lisa's theme, it's very important to monitor bias in the results, and you can have biases in the training data. So, as Lisa pointed out, AVM real estate prices, which go into AVM models, have contain a lot of data from areas that have been historically redlined. If you were looking at mortgage credit and you said, okay, I want to train based on what was accepted in the past, to the extent it reflected loan officers rejecting black applicants more, then AI would do a great job perpetuating this. So it's very important to be aware of the training data you're using. Machine learning algorithms lack transparency and interpretability. The trade-offs between fairness and efficiency are extremely unclear. And you can have a model that is there are a wide variety of models that fit almost equally well most of the time, where the differences in efficiency can be very, very minor, but the differences in equity could be huge. And the models, and the result of the either biases in the training data or biases in the algorithms means that the models could potentially produce disparate impact to neighborhoods and individuals of color. So, just to pick up the point on the trade-off between equity and efficiency, if you don't do anything to debias the data, is, if you look at Model 1, it has a forecast standard deviation that's very small. On the other hand, the circles have a much higher forecast standard deviation than the squares, so the model is more accurate, but it's more unfair than Model 2, where the circles and squares have a standard deviation that is much more equal between the two of them. So essentially, you can think of a Pareto frontier that is the trade-off between accuracy and efficiency. So you have your most accurate model for each degree of unfairness, and we're measuring accuracy as the overall forecast standard deviation and unfairness as the difference in the standard deviation between the two. But you can think of a Pareto Pareto frontier. And then the question is, can you use AI for better equity in, say, mortgage lending or anything else? Can AI push out that Pareto frontier? In the search for less discriminatory alternatives, which Lisa talked about, there are sort of two techniques that have been used. The second technique, which is distribution matching, is the technique that National Fair Housing Alliance used in their work with Fair Play AI. There's also adversarial debiasing, where you eliminate factors that are heavily correlated with race. So, for example, if data collection is heavily correlated with race, maybe you want to make sure that that has a lighter weight in the final function. So you basically look for, you eliminate or weight much less heavily factors that are heavily correlated with, say, race. So there's ways you can search for less discriminatory alternatives that is produce more fair models. And then the question is, what is the trade-off in terms of accuracy? And generally, the trade-off can be very, very, very small. So but it's again, you have to be deliberate about it. You have to say, I am willing to make this trade-off. Or in some cases, the trade-off may be almost nothing if you're sort of on a part of the parabola is pretty flat. There have been some federal regulations to promote equity in AI. The regulation framework wants to safeguard the ethical use of AI to enhance the transparency, interpretability, and accountability of these complex decision-making models. And this is desperately needed. The Biden administration released the PAVE Action Plan in 2022, which included a set of actions to root out racial and ethnic bias in home valuation. Influenced by the PAVE Action Plan, in October 2022, the administration released its AI Bill of Rights that specifically underscores that AVMs should fall under its regulation framework against algorithmic discrimination. In September 2023, the CFPB issued guidance on credit denials by lenders using AI. Lenders have to have specific and accurate reasons when taking adverse actions against consumers. Our model rejected you just doesn't cut it. More recently, the 6 federal agencies issued the final rule to help ensure credibility and integrity of AVMs. The final rule came out last week. It underscores the importance of using the 5th non-discriminatory factor as part of the quality control of AVMs and fair lending. However, the guidance of implementing this fifth control factor on non-discrimination is vague, and it's too non-prescriptive. The rule states that institutions will have the flexibility to adopt approaches to implement the fifth factor in ways that reflect the risks and complexities of institutional business models. While this flexibility can help reduce compliance costs, it also introduces ambiguity regarding the standards of what constitutes a valid business justification. Additionally, the search for least discriminatory alternatives can be costly. If lenders involve third-party entities which use sophisticated learning approaches, it can be costly. How do you incentivize more active, least discriminatory alternative searches? And who should bear these costs? And that all remains unresolved issues. But certainly, when we're thinking in terms of federal guidance, I think you have to think in terms of being a little bit more prescriptive than we've historically been. So let me conclude with my policy recommendations, which I see I'm out of time. But so design with intention, better track the source data to make sure the models are trained on the right data, encode the fairness metric into the objective function, increase diversity among model developers and users, and use advanced debiasing techniques. In short, design with intention. Increase regulatory guidance to safeguard the ethical use of AI, be a little bit more prescriptive, improve the transparency, interpretability, and accountability of AI-based lending practices, and incentivize industry stakeholders to do more through less discriminatory alternative searches. So I think we're going to see big improvements and big advancements in the use of AI in housing finance, and I very much look forward to hearing the results of the TechSprint. Thank you all very much for having me here today.
You have to be deliberate about it. I love that quote. Thank you, Lori. There are so many opportunities and so many risks. I can't wait to see how our TechSprint teams thread that needle on demo day. What a start to our TechSprint week. Director Thompson and Lisa Rice both outlined the very real challenges in the U.S. housing market and what we are facing: affordability, racial inequity, and a supply shortage. Renters struggling with rents that are increasing faster than their paychecks. We also heard from Lori, who explored the ways in which AI could impact housing finance, both for homeowners and renters, examining past regulatory actions on AI and recommending future policies. And now, since Anne-Marie Pippin is unfortunately unable to join us today due to travel delays, I'm excited to kick off the FHFA's second TechSprint in her place as a way to bridge these challenges with technology solutions by bringing stakeholders from across the housing finance ecosystem together to brainstorm with us and explore this transformative power of generative AI. One of the goals of the TechSprint is to advance the conversation on responsible adoption of generative AI, pushing forward our collective industry and regulatory understanding of the technology and identifying ways to mitigate the risks that may come along with its broader use in housing finance. As I mentioned earlier, we are also creating a space with the TechSprint for other regulators to hear these creative use cases in the housing finance sector and to hear from industry as to how to mitigate the associated risks. This will continue to be informative as we continue to think about the appropriate guardrails to adopt this technology responsibly. Does that sound fun? Yes. Or maybe like a big lift? Well, let's talk about here's how we're going to do it. Let me provide an overview of the week's activities. This year, we've organized our TechSprint by centering around the challenge of how might the responsible use of generative AI promote a transparent, fair, equitable, and inclusive housing finance system while fostering sustainable homeownership and rental opportunities. Last year, we had representatives from lenders, academics, think tanks, fintechs, nonprofits, and consumer finance groups among our participants. And this year, in addition to an overwhelming amount of interest from those same groups, we've been happy to add servicers and representatives from big tech to a growing list. We're also excited to have both single-family and multifamily lenders participating this year, expanding the scope of our TechSprint to explore challenges faced by both homeowners and renters. From the applications we accepted, we formed 12 teams that will work together this afternoon, tomorrow, and Wednesday to find ways to leverage generative AI to responsibly innovate in 4 key areas of housing finance. Consumer experience. How might generative AI be used to further educate and empower prospective homebuyers in evaluating, comparing, and obtaining a mortgage loan, and in sustaining their home ownership over time? Assessing creditworthiness. How might generative AI be used to improve the evaluation of homebuyer credit, as well as the fairness of the credit decisions related to mortgage loans, particularly for homebuyers from underserved communities? Operations. How might generative AI be used to enhance the efficiency and effectiveness of operational processes within the housing finance system, from origination to servicing and secondary market activities? Last but not least, risk management and compliance. How might generative AI be used to enhance the effectiveness of the processes associated with risk management and compliance? That's a tall order. I know our teams can do it. The tech sprint will culminate on Thursday, demo day, when each team will come up here and present their ideas to an independent panel of judges drawn from subject matter experts in government, industry, academia, and the nonprofit sector. Think of a housing finance, regulatory, and technology-focused Shark Tank. At the end of demo day, the teams presenting the most promising use cases, framing the art of the possible, along with well-thought-out understanding of the associated risks and risk mitigants, these teams, the team selected by the judges, will be recognized. And now it's time to sprint and for innovation to begin. On behalf of FHFA and the Office of Financial Technology, I would like to thank everyone again for being here for opening day of our 2024 Tech Sprint in person and on live stream. In a moment, teams should go find their spots in the conference room behind the auditorium if you haven't already. You will sprint for the rest of the day, all day tomorrow, and on Wednesday. And we'll see everyone else back here on Thursday for demo day to watch the teams pitch the ideas they come up with to our judges. We hope to see you then. Best of luck to the teams. On your marks, get set, go.